Now, there is an II part, which is the second paragraph of the question. It says, explain how Akakpo Limited should treat the effects of the earthquake in its financial statement for the year ended 31st August 2015 in accordance with IAS 10 events after the reporting period. Now, when it comes to IAS 10 also, events after the reporting period, as the name suggests, these are transactions or events that are taking place after the end of the year but before financial statements are authorized for publication. So let's say that the year ended of the company is 31st whatever, December 2015, and then the financial statements are going to be authorized for publication on, say, let's say 1st April 2016. So between the year ended, okay, and then financial statement publication, between these dates, the event occurring are what we refer to as the events after the reporting period. Now, it is important as accountants we know these events and identify them because they may require us to go back and amend the financial statement or adjust some figures in the financial statement or probably make some disclosures in the notes to the financial statement to enhance faithful representation of the financial statement so that we can be transparent enough in communicating what the users of the financial statement must understand when it comes to they using the financial statement to make various decisions. And so broadly, these events can be divided into two. So we have adjusting events and then non-adjusting events. The name is pretty simple. Adjusting events are simply events which are providing us with information about a condition that existed at the reporting date. So the adjusting events are giving us further information about a condition that existed at the reporting date. About a condition existing at the reporting date. Okay, so what does that mean? So for example, according to the prudence concept, we have to make provision for bad debt. Because when the prudence concept simply states that an accountant or an entity cannot make provision or cannot recognize future profits, but can make provision for future, losses. And so in that case, when we have debtors figure, trade receivables in our books, it's likely that the debtors may not be able to pay all the money. And so prudence concept states that it is better for an entity to make provision for possible losses from the from the debtors before it actually occurs. And so we have to make provision for bad debt. But usually at the reporting date, we don't know the provision for bad debt that we have to make. So sometimes after the end of the year, a customer declares bankrupt. Okay, so customer, bankruptcy could be an indicator to confirm how much debt we can write off as bad or how much provision for bad debt we can make in the financial statement. So you realize that the customer who is declaring or becoming bankrupt after the end of the year, maybe we got this information in January or probably in February after the end of the year, is now providing us with information about how much debt we can write off as bad and how much provisions we can make in the financial statement for bad debt. So that is an example there. Another example is sale of inventories at the reporting after the end of the year. So sale of the inventories after the year ended. Again, in accordance with IAS 2, inventory should be carried out lower of cost and net realizable value. However, at the reporting date, we may not be having the amount at which the net realizable value could be determined or measured for the inventories. And so immediately after the reporting date, the value at which inventories are sold will give us an idea on the determination of the net realizable value of the inventories. So we can now compare that net realizable value to the cost of the inventory to determine whether inventories have suffered an impairment or not. And so anything that is happening that is giving us further information about something that had existed at the reporting date will be treated as an adjusting event. And so for these kind of stories, it means we have to go and amend financial statement. So our financial statement will then require amendment, changes. Because as I said, the customer bankruptcy means trade receivable has been overstated. So we have to reduce it. It means we didn't make provision for bad debt, which means our profit has been overstated. So go make the provision for bad debt or write off the debt as bad and bring the profits to where it is truly, and go and adjust your retained earnings figure in that regard. The same thing happens to the inventories. If we didn't get the closing inventory value right, that means cost of sales may either be overstated or understated, which means our gross profit is misstated, which means our closing inventory on the face of the statement of financial position is also misstated. And so that is why these become adjusting events. And so we have to go back to our financial statement retrospectively and then adjust the financial statement for that year. Any other thing that is happening that is not giving us information about something that had existed at the reporting date is a non-adjusting event. That's all. So any other thing that is not giving us further information about something that had existed, then it's a non-adjusting event. And so for instance here, we'll be talking about maybe acquisition of assets. Okay, that's fine. Issue of shares. Okay, that's fine. Issue of shares. Or if you want loan notes. That's okay. We get it. That's not a big deal like that. Okay, maybe fire outbreak at a factory of the entity. At a factory of the entity, again, no P. So for all these things, they are not giving us information about something that had existed at the reporting date. And so for all these ones, if they are material, then we disclose it in the notes. So this is IAS 10, events after the reporting period. If it is giving us information about something that had existed at the reporting date, we say it's an adjusting event. So we go back and amend the financial statement. If it is not giving us any further information about something that had existed at the reporting date, then it's a non-adjusting event. And if we consider it to be material, now materiality of an event will depend on the discretion of management at the end of the day in that particular case. And so when management decides that it is material, they will disclose it in the note. But there is a condition here. Sometimes a non-adjusting event could be treated as an adjusting event if it will affect or may affect the going concern of the entity. So where a non-adjusting event may affect the going concern of an entity, it is treated as an adjusting event. Now, this is a rare case scenario, but it's something we need to understand. So what does that mean? For instance, the fire outbreak in the factory. It's a non-adjusting event in nature. So if anything, we will disclose it in the notes to the financial statement. It ends there. That is all. However, if this is the only factory the entity has, and there is no insurance to cover it, and the entity is facing financial challenges, and it is not likely the entity can buy the things from a third-party manufacturer and sell as they try to put their own factory in shape, then the entity's going concern is in doubt. For that reason, maybe we have to then prepare the financial statement on a breakup basis, meaning we are in the end or getting to the end because the going concern of the entity is going to be in doubt in that particular case. So that is what we must understand. That and you will see this more probably in auditing, for instance, in auditing than in management generally. The idea is that, management will always be that enthusiastic about the future, right? Not pessimism at the end of the day. They will say, oh, yeah, we know the factory is down. We don't have insurance, which is bad, but we don't have. Yeah, we are facing financial challenges. It's not good. Yeah, it may be difficult to get the things we are manufacturing from a third-party supplier so we can continue in business, but we are working hard to bring the factory up. So they may not want to prepare the financial statement on a breakup basis. But that is where you, as an auditor, if you are an auditor, you would have to then draw the attention of the users of the financial statement. So in the auditor's report, the auditor may include a paragraph on uncertainty regarding going concern and draw the attention of the users about this particular event and why the auditor thinks it may affect the going concern of the entity. So you will see this more from the auditor's perspective rather than from the management perspective, because nobody wants to say the business has no future and lose their job.
Yeah.
So that is the idea about IAS 10, events after the reporting period. So on the basis of this understanding, we then come back to our question here to see. Explain how Acclaimed Limited should treat effect of the earthquake in its financial statement for the year ended 31st August 2015 in accordance with IAS 10, events after the reporting period. So let's see what we have here. It says on 31st October 2015. Now, if the year ends on 31st August, September, October, so this is 2 months after the end of the year, there was a massive earthquake in the area, and Acclaimed Limited's mine shaft was badly damaged. It is estimated that the mine will be closed for at least 6 months and will cost 1 million Ghana cedi to repair. Okay. So how should they treat this? Now, the earthquake happened 2 months after the end of the year. That is not giving us information about anything that had existed on 31st August 2015, the year ended. So because of this, it will just be disclosed in the notes to the financial statement. So we won't make any provision for the 1 million Ghana cedi. It will just be disclosed in the financial statement. So the incident of the earthquake and the estimated amount of repair must be disclosed in the notes to the financial statement, as this is a non-adjusting event.